This is the Self-Storage Podcast, where we share the knowledge and skills from the industry's leading investors, developers, and operators to help you launch and grow your self-storage business. I'm your host, Scott Meyers, and over the past 16 years, we have acquired, developed, converted, and syndicated over 2 million square feet of self-storage nationwide with the help of my incredible team at selfstorageinvesting.com, who has helped thousands of people achieve greatness in self-storage. Hello, everyone, and welcome back to the Self-Storage Podcast. I'm your host, Scott Meyers, and this week's podcast is sponsored by PassiveStorageInvesting.com. And I'll just bet, if you were like the thousands of investors looking for yield out there, then you have come to the right place, because since 2005, we have bought, sold, converted, and developed over 2.5 million square feet and over 15,000 doors in self-storage. And for all the reasons that I love self-storage, it is the recession-resistant and pandemic-resistant nature that has kept me in this asset class for so long. So I invite you, if you haven't already, which I'll bet you have, which is why you're here, but do your homework. And then head on over to PassiveStorageInvesting.com, as we'd love to have you partner alongside of us on one of our many projects as we head into what will be the greatest and most profitable cycles for self-storage that we've been preparing for since the last recession in 2008. I mean, we are literally coiled up like a spring, ready to explode as the demand for storage continues to rise during the recession, as we deploy our plans to develop, convert, and acquire all the value-add opportunities that this downturn will bring. So head on over once again to PassiveStorageInvesting.com to learn how to come and invest with one of the most experienced teams in the business, which is why this podcast is so timely, because our guest, Dustin Heiner, is the founder of Master Passive Income and Real Estate Wealth Builders Conference, and Successfully Unemployed. Those are his 3 businesses. And he is a real estate investor who was able to make enough passive income from his business to quit his job when he was only 37 years old. And now with his podcast, YouTube channel, books, courses, and coaching, he now helps other people to quit their job by passively investing in real estate to live their dream lives. And I wanted to have Dustin on the show to discuss the reasons why investors are looking strongly at investing in passive investments right now, and how to map out your road to financial freedom by investing alongside of other experienced investors like us to achieve your goals. So without further ado, please enjoy my wide-ranging conversation about how to win by passively investing in self-storage with my good friend, Dustin Heiner. Craig, great to see and hear you again. Welcome to the show.
Well, Scott, it's a pleasure to be here. Thanks for having me, man.
This will be the first of many podcasts in which you and I are going to break down, well, a little bit about the economy, a whole lot about self-storage, current affairs, and really kind of revealing our business plan and what we're doing, how we're pivoting in this market right now. But what I wanted to do, since this is your first show, your first episode, I've given everybody a little bit of background on you, shared your bio, but if you wouldn't mind, why don't you fill in the gaps and talk about how you got to where you are now working with us here at selfstorageinvesting.com.
Well, I could start at the beginning, but that would take way too long and be way too boring. So I'll start at where my investing career started. I'm a husband of 18 years to my beautiful wife, Tracy, and I have 2 kids, Brooke and Jake, 14 and 16. And I've been investing in real estate for about 15 years, mostly residential. I've done hundreds of flips in the Baltimore metro area where I grew up. And, needless to say, it's been a roller coaster ride from 2004 until now, going through the rocket ride of 2004 to 2007. And then, strangely enough, I was just talking to my wife, Scott, about how we made so much of our income during a time of economic upheaval, which you and I are going to talk a lot about. So from that 2007 to 2012-13 time period is really when my business as a residential flipper took off. And since that time, I've coached just hundreds of real estate investors. I run a men's group of really successful guys from around the country who are in all different asset classes. Scott, we've got guys in self-storage. I've got guys that buy mobile home parks. I got guys who buy notes. And so it's an honor and a real pleasure to learn from those guys as well in those different asset classes. And so to be here with you as one of the top guys in the self-storage space is a real pleasure. And I'm looking forward to talking about the economy and where we're in this roller coaster ride we're on right now for the next few years, it appears.
Well, Craig, you have your finger on the pulse of our community. That is your role here. And there's an awful lot of questions surrounding what do we do? Where do we go from here? Inflation is taking hold, and there's the fear, threat, and the reality of rates going up. And a lot of banks have pencils down because they are waiting to see essentially what's going to happen in the market. So we're going to touch on several topics, but before I throw a whole lot at you, let's discuss your take right now, or maybe even let's entertain some of the questions that the community has around interest rates and what does that mean as an investor. I can probably guess what that looks like, but share a little bit about what the community is looking for, and let's have a conversation about that.
Well, I think it's really important to sort of take a look at things globally, not just sort of, yesterday, there was a 75 bips raise in the Fed rate. We should talk about that. But really, what does that mean today? What does it mean tomorrow? What does it maybe mean 6 months from now, or maybe a few years from now? Because Scott, I feel like you and I have sort of lived through this. It's not a mortgage meltdown like it was in 2007-8. It's something different. But as a country right now, it feels like the crisis du jour, what are we going to be facing next? And so I can understand where the folks who are in the academy are probably feeling some jitters, maybe some stresses and anxieties and fears. And so my take on all of that is we've got inflation that is at a 40-year high, the likes of which that many people who are a part of the group probably don't remember, Scott. They didn't live in the 70s, or maybe they weren't old enough in the 70s to remember 20% interest rates for buying houses and things like that. Well, I think we should get into the details of all of that, but I think we should start with some good news. The good news is I feel like, Scott, there's opportunities in every market, in every economy, right? There were still plenty of people buying houses in the 70s and doing well with them. There were still people building self-storage in the 70s, even with those exorbitant interest rates. And frankly, the high interest rates in a down economy, Scott, have a way of sort of shaking out the dead wood in this business, doesn't it? Right now, I think the deals are king and cash is easy to come by. It's slowly turning from cash will be hard to come by and the deals will be plentiful. Do you agree?
100%. And that is, I think several folks here have heard me make this statement before, and that is we've been preparing for this since basically 2009 to 2010. I've been through, this will be my third recession. And through 99 and 2000, I was primarily in single family rentals and multifamily as a buy and hold as a landlord. And we didn't do so well during that recession in trying to turn things around quickly to then turn into a seller when the Community Reinvestment Act came out. And that administration at the time felt that anybody that could fog a mirror could buy a house. Well, we weren't selling houses, we were holding, and all our tenants were leaving. And that caused a lot of stress. After that recession, that's when we got into self-storage. And that going through that recession, recognizing that self-storage is not recession-proof. No business is recession-proof, but is the most recession-resistant asset class in all of real estate because people were downsizing, businesses were downsizing, and they moved their goods into storage or items into storage when they had to go back home and live with somebody else, consolidate. When businesses went out, their inventory went into self-storage, and so self-storage was just on a tear. Had the lowest loan default rate. And the banks loved it. They were still lending on self-storage acquisitions and development. And so I was in it at that time, getting in it, having been in for 3 years, but hadn't really amassed a large portfolio and hadn't really raised a lot of capital or had a lot of cash sitting on the sidelines, as you mentioned, Craig. And so, we recognize and realize that the folks that made the major acquisitions and the land grab, if you want to call it that, during that time, those are the ones that came out smelling like a rose. Then when interest rates went down, cap rates went down, valuations went up, and they were in a position to either refinance or sell. And so history has a way of teaching us an awful lot. And so what I learned in 2009 and 10 is that we know that a recession is inevitable every 7 to 10 years, like clockwork, since the beginning of time. This one got kicked down the road a little bit longer before it hit. But we knew that we needed to have a team of lenders that knew, liked, and trusted us going into the next recession. We knew that we needed to have a war chest of capital, whether it's cash on the sidelines or access to that capital. And so we knew that when everybody was going to be running out again, and as you said, when you shake the market a little bit and the cream rises to the top, there will be a whole lot of investors that bought into self-storage because it was great and they knew it did well, but they didn't know the business. They didn't know how to create value enough to be able to hold on to their facility when it came time to refinance at a lower loan to value during a recession and a higher interest rate. and that we would then be there with our cash, our capital, our lenders, to be able to not take advantage of them, but the situation, recognizing that the market was shifting and that we were in a position to be able to take advantage of those market shifts. Same with development. There's going to be abandoned development projects where all of a sudden they don't pencil out when you have a 75 bips increase in interest rates, or even a 50 basis point shift. And we were going to be able to step into those as well. And well, that time has come. This is our time that we have been waiting for and preparing for. And so you're right. A deal is a deal, regardless of the interest rates. I mean, that factors into everything. It doesn't mean that we're not doing our underwriting and analyzing. However, we're in a position now coming in as a buyer where we're in a completely different situation than a distressed seller who has a property that where the value doesn't work at the current rate of their capital, or a developer that can't make a project work any longer at the current rate of their capital. So we've been waiting for this, and we're we don't celebrate recessions, we don't celebrate pandemics, but we're pretty excited that we're finally in this place, and looking forward to the next couple of years.
Yeah, that's a lot to digest. A bunch of questions there. So if I'm a new self-storage investor in the Academy, and I'm looking around at sort of the news, what's going on in terms of lending right now, I feel like, Scott, I've talked to several pretty smart guys, big lenders, local lenders in my Maryland metro market. Speaking to one guy who lends about $90 million a month in hard money and refi money. Their business is off 40% in a week and a half. Literally, the phones have stopped ringing because they're borrowing from Wall Street. Their rates have gone up 200 basis points in a week and a half. And so phones have basically stopped ringing. That was about 3 weeks ago when I spoke to him. Spoke to another gentleman yesterday who is a big Wall Street debt lender. They've frozen. Their desk is frozen. They're not lending. And so if I'm in the Academy right now and I'm sort of hearing this, I'd say to you, well, okay, I hear you. You said, Scott, that you've been able to raise private capital. What does that look like? Who are those people? What is sort of the makeup of that person who you're getting private capital from, Scott? And if it's not necessarily you because, you're a little bit more sophisticated, more experienced, who would a new person go to raise this private capital you speak of?
Yep. So let's take a step back and just look at an acquisition. If you're a new investor, pretty typical transaction when you're first starting out is you're going to find an existing self-storage facility. You're not going to look at biting off on a ground-up development, especially in the environment that we're in right now. But you're going to have a track record and a history of financial performance of this facility. Well, to get the lion's share of the capital, you're going to go to a traditional lender, a bank. I'm going to go to the large folks, but mostly to the community banks, the credit unions, the savings and loans, the folks that want to put these self-storage facilities on their balance sheet because they know that this is the asset class to have on their books during a recession because it has the low loan loss and low loan default rate. So when times are good, and I'd say even 2 to 3 months ago, you'd be looking at in a strong facility and in a good market and a strong growth pattern in terms of occupancy and rent growth, 75% loan to value is going to be typical. And then at regular interest rates, whatever they are at the time, however they set their rates, usually very low loan costs to get to the 1 point, maybe a half point to originate, and then typical closing costs. But then if it's let's just say $1 million facility, then somebody coming into that project is going to need $250,000. So they may be able to do that once with a self-directed IRA that they've shifted over from a traditional 401k or cash or a 1031 from somewhere else. But you can do that once, and then the next project, typically you're looking for that private equity, or sometimes you're looking for that as well. So that is what we traditionally call friends and family money. And that is a very broad term, as you and I both know, Craig. So that literally is people that want to come alongside of you, like what you're doing. They know, like, and trust you. You educate them on self-storage if they're not aware of it already. And, as long as they feel comfortable with you, they feel comfortable with the asset class and the deal itself, then you've created a structure, typically a syndication, where they can invest, usually a minimum of $25,000 to $50,000 to invest alongside of you. And then you have a pool, a syndicate of investors that will then make up the equity portion of the down payment. And for that entire pool gets 30, 40, 50, 60, 70, depending upon what the market is looking at in terms of returns and what the property itself will produce by splitting up those shares of equity. And so they'll invest alongside of you as a group and then get a share of, pro rata share of the ownership and therefore the cash flow and then the equity on the back end when it sells. So I'm trying not to make that too convoluted, but at the end of the day, you're bringing forth a whole lot of folks, or perhaps the best case scenario is one person that writes a check, strokes a check, your rich uncle, or trusted a business partner or somebody that can make up the entire $250,000, and then you can perhaps go into a partnership and bring that project down. The good news is right now is that, in light of the fact that there is so much negative news out there with regards to the lending environment and inflation and the economy, those are the masses. But, those of us that are active in the marketplace, we're gearing up, we're ramping up, we're adding staff, we're looking at a whole lot of projects right now because we know that this is the time to be able to grab those projects that are distressed and are troubled because we know that self-storage does so well during this economy.
I want to encourage people as well, Scott, that look, if you're a new investor, if you're looking at your first storage deal, trying to put out offers and turning over stones, let's talk about why. Let's talk about why friends, family, or fools, as I like to say, would lend you money at this time. Well, if I'm a guy who's got an IRA, maybe from an old job, and it's just sitting there doing sort of nothing, I'm looking at that IRA right now and I'm saying, well, holy cow, it just lost 10% in 2 days in the market. Holy cow, they just raised interest rates and now I see the market going crazy again. And so we see this capital, Scott, fleeing from stocks and equities right now. And what else do we know? Well, we know in inflation, 40-year high, that the bond market is also puking. The bond market is not a place to be right now. It's actually even worse to be in the bonds than it is in stocks. And so now you have billions of dollars of capital looking for a place to go. And Scott, I'd love for you to talk about what hard assets look like in an inflationary period and why self-storage is such a great story to tell if I'm a new guy. I go out and I find a deal, and you said it. It's let's call it $1 million, even though we know we can find deals for less than $1 million, right? Good storage facilities out there to be found for less than that. But let's just say the purchase price is $1 million. I'm able to help the student write up a nice pro forma, make it look good with the templates that the academy has, and now we can go out to private investors, show them this performing asset. But why, Scott, would it be a place? These hard assets be the place right now for these people to invest in?
So the answer to that is that you've partially answered it with your question. We know that during an inflationary period that investors by the millions exit Wall Street because they can't get yield anymore. And investors are looking for yield. They're looking for a return, and they can't get it in Wall Street any longer, or it's too big of a risk. They've lost, as you mentioned, in your hypothetical / real example, they've lost a significant amount of their wealth. And so now they're going to take it out and it's going to sit on the sidelines. So where are they going to deploy it? In the next place, the next environment in which they're going to get a yield that isn't going to go down. So, well, first of all, it's hard assets, something they can see, touch, and feel that isn't affected by fear in the economy and rates and manipulated by inflation and interest rates going up. Well, although commercial real estate and self-storage is affected by interest rates in terms of its valuation, there's a lag time involved, but you only get affected by that when you sell. So in your example, as you're looking right now, nothing has changed in terms of how we evaluate or underwrite a self-storage facility. We plug in the income and the expenses of the facility, and then after that, we look at our net operating income. We look at the cost of our capital and our capital stack, as we call it, and we're stacking on the capital from the lender. Here's the interest rate where the lender is going to be, where it used to be at 4 7/8. Now it's at 5.5, maybe 6 is what we underwrite it at. Well, does it pencil out from a debt service coverage ratio? And then if we're adding and borrowing private equity on top of that, then we run the numbers again to say, can we give these investors the internal rate of return that they're looking for, the equity multiple in a 3, 4, 5-year period that is going to attract enough folks to say, yeah, I want to invest here and I'm not going to invest in the stock market. And yes, these are based on projections, but it's based upon the capital that is going to be locked in for this amount of time, and it's based upon an exit cap rate and a projected value in the future. with normal rent increases and normal operating expenses. And that we look to, again, the history of the facility, the history of the market. And then that investor, that passive investor, is going to be looking to the strength of the syndicator or the promoter, in that case being myself or anyone else, to say, well, do they have a history? How long have they been in self-storage, first of all? Do they have a history of performance? How many times have they done this? And that means not just how many times have they purchased a self-storage facility or developed, but have they been through an economic cycle? And that is rare air. There's not as many passive investors out there, or syndicators, there are not that many syndicators and promoters that a passive investor can invest with that have gone through an economic cycle, that have been investing since prior to 2008 in the fall, that have been through maybe 2 recessions like ourselves. And to say, well, these folks have been through 2 recessions or a recession, and here's how well they have done. So I feel comfortable placing my money and investing with them, because this is a place where I feel that not only the industry looks good, this deal looks good itself, but then this promoter also has a history of performing. So again, a long-winded answer to your question, Craig, but I think there's multiple things that somebody looking to invest in needs to look at, and that is, if you're going to invest passively, doing it alongside of somebody who is experienced, who's been through a recession, and you can see that their underwriting is based upon the current cost of capital, and that the projections of when they're going to sell is fairly conservative, and taking that into consideration as well. And if you're an active investor looking to do that yourself, same rules apply. You're going to underwrite it conservatively using the current interest rates. As you mentioned, nothing changes. We're looking at a 2 to 3 point spread, usually a 3-point spread between our interest rates and the cap rate in which we acquire, or where we're going to be stabilized. It's our yield, and that is our spread. And if the deal doesn't make it there, then guess what? We pass. We move on.
It's funny, Scott. So yesterday, I don't know if you know this or not, but I'm looking at self-storage. And I'm also looking at a couple other asset classes as well. So one of the things that we had to do yesterday was just start calling some brokers in the markets that we like, things that we teach the students every day, start developing the relationships to find those assets. So if you're looking for industrial property, you're calling on brokers that may have dealt in industrial, right? So yesterday we were smiling and dialing to talk to some brokers. And I'd love to get your take on this. You said nothing changes, right? So we just underwrite we underwrite with different interest rates. What does change though, Scott, is the seller's expectation on what they can get for the property, right? And so one of the things that we heard yesterday was it's slowly changing. Like from literally 3 weeks ago to now, we've got sellers of assets, be it self-storage, industrial, whatever, who are starting to say to themselves, maybe that $1 million that I thought I was going to get from my property, maybe it's not $1 million anymore. They don't know what it is, but at least they're starting to think in their heads, man, the economy's changing, and people probably, and because interest rates are rising and people want to get that yield, look, we have to make cash flow above what we pay for these things, right? And so the sellers are starting to get a little bit attuned to the fact that they might have to come down in their asking prices. Are you seeing the same thing?
Yeah, and that also is really no different. What is happening with the interest rates now rising is that in creating a hyper awareness by the sellers to think, did I miss the train? As left the station. They've heard their cohorts at their local self-storage association meeting, or friends in the industry, or they're just looking around on the internet and seeing that valuations are going down. At least that's the savvy folks. Many times we as buyers and the brokers that are looking to list a facility, they have to manage those expectations of a seller. And so for some of the facility owners that we approach, many times they are mom and pop, and I don't mean that in a bad sense, but that they're not as sophisticated in underwriting and doing a financial analysis on a project. And so when we gather as much as we can data on their facility, and we're plugging it into our software, our Excel, we're running it through the analyzer, and then looking at the net operating income, here's the yield that we need to have based upon today's capital, and then we back into a purchase price after that. And so many times we are educating that seller to say, well, I'm not trying to steal your facility. There's no rocket science here, and we won't give them our underwriting and our analysis, but we'll lay it out and I'll move it across the table for them to look at to say, this doesn't make sense. The bank won't lend on this because the debt service coverage ratio is enough. At the price that you want for this, it doesn't make sense. And there's not enough yield for me as well. We're just not interested at this, even if we had cash, because that's typically what will come on next. Well, it's worth it. I know it's worth it, and somebody will come along and pay cash. I said, well, anybody who has that amount of cash, no offense, Mr. Seller, but they didn't get that way by overpaying for a facility, and I mean that in the kindest way. But showing them with the math to say, this is, an appraiser is not going to give you that value, and a lender is not going to lend at that value, and we just can't buy it because there's not enough room there, and I can't get my investment partners to get excited about it because there's no money left for them as well to come into this. And so whether that's us, meaning the buyer, taking off our buyer's hat and putting on our consultant hat, recognizing, they want $1 million for the facility, but when we, underwrite it and analyze it at today's current interest rates and their NOI, the thing's only worth, $705,000,
Sure.
That's our max on it. And so we just let them know. They say, this is really all we can do. And I'm not trying to offend you, but here's the things that you need to do to increase the value of your facility. You need to raise rates. You need to increase the income and reduce your expenses and hope the interest rates don't go up in order to get your $1 million.
Well, heck, we don't want to teach them all the right things to do we? That's for us to do, right?
Yeah, exactly. But that's, it's one or the other. Or you decide here's where the market is, and if you wanted to sell it now, you're probably going to be in this range. And if I'm not the buyer, which I'm not right now, I think anybody who's going to evaluate this facility that's in our same position, is going to come along and come to the same valuation for you.
I'm curious, Scott, as someone who's been through this now a couple times, with residential, that price awareness of what your house is worth happens pretty fast. It's not a lagging indicator, right? Like the market goes up, it goes down pretty quickly. But as someone who's been doing this for a long time, what would you tell our students and listeners who are out there looking for properties when they go to that property and they're thinking, it's worth $700,000, but the owner still thinks it's worth $1 million? Are we talking now you've got to just have a persistence play with this person? Do you give up on it? What's your method there?
Yeah, just taking their temperature to see, first of all, do they feel like the train has left the station or is leaving the station? And so now they want to see how much they can get for it. And they really weren't in a position. They probably had, a dozen letters land on their desk from us, asking them to sell, and other folks contacting them, and brokers, giving them an opinion of value and asking if they wanted to list it. And now they're thinking, I probably should have done it. Let's test the waters. That's one seller. Versus the seller that says, I don't want to wait. I want to retire. I don't want to wait this cycle out another 3-4 years till interest rates come back down in order to sell. So I'm willing to take a little less. And just kind of gauge that and say, well, if they say, well, I've got a little bit of wiggle room, I can't come down to 700,000. Well, what does that look like? And see if that is a number that makes sense for you and if there's enough upside. If they're a mom and pop seller that hasn't raised rates in 3 or 4 years, and they're running it very efficiently, and it can run with a kiosk, and you can reduce payroll and other means and ways that we know how to make these properties sing by maximizing the NOI, by just ramping up the income and reducing expenses, then you need to underwrite that to say, is it worth it to pay a little bit more for that facility right now, or is he just stuck on $1 million? And in that case, we never burn a bridge and just tell him he's crazy or she's nuts for wanting that number. We just say, well, that's great. Would you mind if I check back with you maybe in a year or so, see what the interest rates look like and what you've done to the facility, and maybe we can strike up something at that point. That's usually the two ways.
Yeah, let's talk about get back to the financing part of it, which is so critical in these down markets. Because look, if you mentioned you're going to walk into one of these facilities, there might be 12 other letters on the guy's desk from other investors who are interested, right? Here's the differentiator. Do those other investors have cash? Do they have their capital ready to go? Or are they still working with the bank who is now taking 90 days and who's got a box of criteria that has now just really pinched them into a place where it's got to meet all of these check boxes for them to. So talk about, Scott, how important it is in a time like this when you walk in and now you're sitting in front of a seller to be able to say, oh, let me show you my proof of funds where I know we can do this deal for you.
Mm-hmm. Yeah, that's another arrow that we put in our quiver to let them know that, first of all, hey, we're experienced. This isn't our first rodeo. And we're looking at a lot of facilities right now, and we know how to buy and or develop, create value and sell. We have great lending relationships with a lot of lenders. And so if the facility makes sense, then we won't have, if it makes money and it meets the bank's criteria, we won't have a problem getting approved for the loan. And if it is a traditional, structure and traditional deal in which the bank is interested, then typically it is not an issue to have our investment partners come alongside of us. And here's what we've done. And so, in days of old, we used to bring in a credibility kit if we were on, perhaps that call or that next visit where we let them know, who we are and why they want to be chatting with us or doing business with us, and now we send them to our website that shows, our credibility, what we've done in the past on projects that we have working right now. Because they could have one of those folks that has sent the letter, never visited the property, offer them $1 million, and they tie it up with the contract, and then all of a sudden it gets to the bank, or they, that buyer, if you will, that sent a letter has never underwritten it, never set foot on the property, and then all of a sudden they get the financials from the seller, and what they may tell you, Mr. Seller, is that this is only worth $700,000. So as you see, our offer was based upon our due diligence, and here's what we found, and that it's really only worth $707,000, and so this is our maximum offer. So they're either going to write it at the same place, or they may make you an offer, but Mr. Seller, here's a word of caution to you. You need to vet them and see, do they have proof of funds? Have they? How many deals have they closed? How many projects have they been in? And how long have they been in the business? Do they know how to navigate this environment that they're in right now in comparison to a company like ours that has been through 2 recessions? So not downplaying, all the other folks out there talking badly about our competition of buyers, if you will, buyer pool. But again, we've got our consultant hat on right now, because if this deal isn't going to come to the closing line at $1 million, it's just not going to. And so what we want is, when he's ready to either be realistic and come down to $700,000, or in the future contact somebody, the approach that we take in consulting with them is what's going to give, have them give us the phone call versus, the blind letters that have gone out there in the past. And so that's what we want to do, is just position ourselves that we can work alongside of this seller to come to, the closing table and provide a solution for him if he really wants to sell.
Yeah, I think if I could just restate what you said there, it's so important in any market, frankly, but especially where in competitive markets. And let's be honest, just because there will be a lot of investors who sort of fall by the wayside in a down market, that doesn't mean it's still not competitive. And it's important to put your best foot forward when you meet with these potential sellers. And that means having the right team in place for your financing, having the right team in place to help consult you, like I know you do with a lot of the students, having that best foot forward to make you look as if you're not a shark, not a shark or a hawk, but you're competent, you know what you're doing. And that gives the seller look, it's important for them to know that the other 11 offers or the other 11 guys that sent them letters are not all created equal. And the more you can show them that you are sort of a step above, that you do things differently, that you have all your I's dotted and T's crossed, I think that makes the offer that you might make that much more compelling, even if it's a lower offer than they expect. Correct?
Well, without a doubt. And when these folks have come to that place when they are looking to sell, and I'm not talking about the folks that are just looking for a big number because they heard that they can get a big number in today's market, but the folks that are ready to transact, or that they need to, they've got an issue, a personal issue, a tax issue, a divorce issue, their other business is tanking during the recession. They just need cash and they need to get out. Mm-hmm. They're going to look to somebody that they feel comfortable with, that they're going to get across the finish line.
Someone that can get across.
This is a commercial transaction, and we're 60 to 90 days into this. And if they have somebody else who is not qualified to do so, to tie up their property for 60 days, that could mean that the death of their business, or a very big challenge ahead of them if it doesn't sell within that time frame. So we are certain to put that fear, uncertainty, and doubt in their mind that if they go with somebody else, how qualified are they versus working with somebody like ourselves.
Sure. Well, I'd love to sort of switch gears here and talk about, I know you personally have been doing this a long time. You have climate controlled facilities. Yes. You do development. Most of the people who I believe come into the academy are looking in those secondary and tertiary markets. So I'd love to hear your thoughts on how the economy is changing and how it affects sort of markets like that, Scott. Sort of those sometimes are the markets that are hit hardest in terms of recessions. Folks that own homes, want to buy groceries, they get laid off, things like that. Love to hear about, you're not in the big city anymore. You're not out in the expensive burbs. Talk about how the changing economy affects those markets.
Mm-hmm. Well, I'll point to what we've seen in the last recession, the most recent recession, and that is, we had thousands of units back then, not near as many as we have today. We're now approaching 15,000 units and over almost 2.6 million square feet. In 2008 and 2009, we had about a fourth of that. and across our facilities that are in secondary markets, tertiary markets, and very few that are truly in, say the urban MSA, in like a downtown area. But just about everything we have is in the secondary and tertiary, but not rural. But regardless, what we've seen is just this cycle that happened over time. So when Lehman Brothers fell, we had a big issue, and a whole bunch of folks lost their jobs. The market came to a screeching halt. The economy came to a screeching halt, and a whole lot of folks got in trouble very, very quickly. We saw that happen also, a mini version of that, but a repeat of that during the pandemic when there was a lockdown. And what happens during that time is, there's a whole lot of folks that lost their jobs, a whole lot of small businesses that went under. And what that caused is, from a business side, the commercial folks, they were putting excess inventory and sometimes even their own, furniture, cubicles, desks, what have you, for their business into self-storage until the economy turned around again. Then those individuals that couldn't make it, lost their jobs, moved back home with their parents. They moved in with friends, family, and so there were still goods and items that they put into storage until the economy turned around again. So we have this huge surge in demand for self-storage and a lease up and an absorption in the industry and rates increasing as a result of that, because at that same time, simultaneously, what we're seeing right now was the same as back then, and that is the banks are sitting on the sidelines, pencils down, waiting to see what's going to happen in this economy, much like they are right now. So they're not taking on new development projects. Those have, I don't want to say come to a halt, but they have certainly lessened until everybody figures out what's going on. So you have a surge in demand. You have nothing new coming into the market right now online, and so up go the rates. That's why self-storage does extremely well during those times. And so as the economy then continues to slowly recover, like we saw back in 2009, 2010, when interest rates began to fall and the economy got a little bit better. Well, first of all, there was this long lag time until that happened. And so they have to use storage until they can figure out what to do with it. And usually the last bill to go is always, the cable bill, the Netflix bill. I'll give up everything except cable bill. So they'll scale back and they'll cut everything. The second to last to go is storage. And then the last to go is their Netflix bill. And so
don't take my phone.
Don't take my phone.
Right?
Yep. So they'll continue until they can't any longer, until it becomes a budgetary item and they look at everything that they have left to whittle down. It's just like, okay, I'm going to have to sell off, throw away the stuff in the storage unit, go through it, and then put the rest of the stuff somewhere for free at my parents, somewhere else, and in my current residence, in the back of my truck, wherever that is, sell off the rest because now that's a budget item that I can't afford at $75, $100, $150 a month. The urban areas, as you mentioned, the MSA, most of the folks are a little more affluent. Those facilities aren't affected. Secondary markets, still not affected too much. The tertiary markets out there a little bit further. The accounts receivable goes up a little bit. Occupancy may take a dip as a result of that as well. But we didn't see that, Craig, until really 3 years on. I mean, just
really?
as the recession really lagged on before it picked up, it was a while before that became an issue. But again, the reason why self-storage has been so popular since that time is because you continue to look back at the 25-year performance of self-storage through 2 recessions and a pandemic. It's not recession-proof and pandemic-proof, but it is done better than all the other asset classes. And so that's why people are looking to self-storage as an investment, both actively and passive investors.
Talk about how you underwrite. I've seen some of the underwriting. I'm still new to the way you guys underwrite, and really just sort of self-storage underwriting, so just being perfectly transparent there. But when you're looking at a facility, and let's say it's got obviously a mix of different types of units in terms of size. So you're getting anywhere but say between like $80 and $200 a unit, okay? And that's current before you take it over. I know the thought is always, well, can we raise rents? Can we raise rents? Tell folks how important it is to in an economy, and I'm learning here, so I don't know the answer to this question. How important is it to underwrite the facility the way it currently performs versus the way you think it's going to perform when you take it over?
Well, we won't move forward unless we do that. That is just part of our basic underwriting. So, we essentially have 3 sets of numbers that we look at. And the first is, where has it performed up to this point, and what should be our offer price based upon that? Because especially if they weren't running it very well, we're going to underwrite it with high expenses. All right.
Yeah. No, I apologize. Go ahead.
That's a good edit point because I'm trying to clear my throat.
I'm so sorry.
No worries.
Okay. Just getting my My coffee handed to me. I apologize.
There you go. Perfect. Yep, that works. All right. So,
you want me to ask the question again, or?
Nope. I'll just answer it. Very, very good point, Craig. And as you know, there's really three sets of numbers that we look at before we move forward, period. It's not just one set of numbers. And so the first set of numbers is, what do we get from the seller and where has it performed up to this point? Looking back, not only T12, the last 12 months, but, the past 2-3 years, if we can get it. Then we look at the current street rates. What are they charging right now in rental rates in the market? And how does that compare? Are they setting the rates in the market? Are they the highest? Are they lagging behind by $5 a unit, or are they 20% behind the rest of the market? And where can we take this facility as a result of that? Can it be run more efficiently by utilizing a kiosk or a call center? Do we really need to have somebody sitting there in the office? The owner taking a salary, or their sister-in-law who didn't have a job, and so they just put her there for 40 hours a week and gave her more than she should be getting. What can we do in terms of the current numbers, so that the day that we take over, say 30 days after we take over, what does the facility look like? But based upon those numbers, the worst set, what I would assume the worst set of the owners, that's what we base our offer on. Now, the next set of numbers is, what's this thing going to look like under our management? We've reduced the hours of the manager or turned it into an unmanned facility. We're able to restructure the property taxes so that it's not so high in the way that we acquire it. We raise rates. We add, retail, selling locks, boxes, moving supplies, and renters insurance. There's all these ancillary income streams that have not been utilized at this facility. We add U-Haul in as an agency, and we have that income coming in. What are all the ways that we can affect the income, and then how can we reduce the expenses? What should our NOI, net operating income, look like for the year at the end of year one? And then we compare that. We don't make an offer based on that, but that's really just kind of for us to look at. What's that delta? Within a year, how much more cash flow, and what does it look like in terms of a cap rate and debt service coverage ratio? What do all the financials look like in a year? Then, is there an acre in the back? Is there a half an acre next door that maybe we could buy and develop on? Or, with normal rent increases, where do we feel that we can take this facility in, say, 3 years or 5 years and either refinance or sell? And that is our last number. So let's say the occupancy is it's a large facility and the occupancy is really low. Well, not only can we raise rates and we can increase occupancy. If it's a large facility, maybe it takes a couple of years to get that stabilized and get everything working the way it should, and maximizing the NOI and the value. Is it 2 years? Is it 3 years? And that's our third number. So when we look at the current price and the NOI that is based on that, is it high? Is it low? And even if, let's say, at today's current interest rates, let's just say at the time of this podcast, let's say interest rates are at 6%. Well, I'm looking to buy it roughly at an 8%. I'd like there to be a 2 to 3% buffer, all things being equal, even though that's not a great opportunity. All things being equal, we need to have that 2 to 3% buffer, that yield, that increase in cap rate. That's where we need to be, and that's usually where the lenders are going to be as well in terms of its underwriting, and will it support the loan that we're going to place on the facility. But even if that's kind of tight, in terms of a cap rate, let's say, if interest rates are 6, I want to buy it at an 8 cap or better. But let's just say that the NOI doesn't support that, but the interest or the rental rates are 20% below the market, and it's only 70% occupied. Well, here's where I can take it in a year, and if I were to buy it at that NOI, it's really an 11% cap rate. And in 2 years, when perhaps we add on to the additional acre that's on the site, and I increase rates even more, and I reduce expenses even more, now buying it at this NOI would have been a 13 or 14% cap rate. Or at the end of the day, here's where I can sell it, and this is how much money I'm going to make. I've got those three sets of numbers that I'm going to base my, purchase my acquisition criteria and decision on. Is where is it now? What I can buy it for? Where can I take it in a year? And then where can I take it in 2 to 3 years when it's completely stabilized? Does that make sense?
Absolutely. And frankly, a broader answer than I was actually hoping for. But let's talk in terms of the poo-poo hits the fan. We hit ourselves into a recession. Now we're seeing some vacancies. I often hear from my friends who own self-storage, they say, one of the things I love about self-storage, Craig, is that if I'm at $120 a month for a unit, I can lower that easily to 80 and still make money, Craig. And that's a significant, that's a 40% drop in what you're currently collecting on a potential unit. So my question to you is, for those who might be listening, for our students, who have fears and real stresses about sort of like, man, where is the economy going right now? I hear you, Scott. I know I can make this a better performing asset, but what happens if I have to pull back? Talk about that. How important is it to buy a facility with the notion that you may have to pull back?
Mm-hmm. So I'm surprised that we've been chatting this long, Craig, and I haven't said, well, it depends. Because most of your questions and these discussions, I will use the disclaimer as it depends.
Of course.
We know as we head into a recession that in the past, again, this will be the third one that we head into. As we head into a recession, liquor does better than any other sector of the economy, followed closely by in either second or third in terms of sectors of the economy that do well by self-storage. It's always in the top 5 because people, they can't afford a vacation, but they can take a liquid vacation. They won't give up their liquor. Sometimes it helps during a recession to forget about what's going on. But the reality is, as we mentioned before, all those reasons why self-storage does so well. So it's an essential business. That's why during the pandemic, it didn't shut down. It wasn't, considered an industry in which the government said, no, we're going to shut down self-storage facilities. It's an essential business, and because it serves a purpose, and that's what happens as we head into a recession. Also, to your point, the average break-even occupancy in self-storage is lower than all the other asset classes. In multifamily, it's hovering above 80%. You need to be above 80% occupancy on average in multifamily to break even. In self-storage, the average is right around 65 to 67% as an asset class. And so either you don't have to be as good if you want to look at it that way. The facility doesn't have to be that strong, but it's better to be in an asset class where you've got a little more wiggle room, and I'd rather be in an asset class where I've got bigger buffer and a bigger swag that I can reduce. And that's, to your point, Craig, it's a common practice by many of the REITs, the real estate investment trusts, the big guys out there now, that during the winter months, they know that people scale back and they use less storage and there's not as much demand for it. And so they'll lower rates intentionally to keep folks from either just saying, I better get rid of this bill, I better get rid of some stuff, or move, begin to price shop and actually move to another facility. And some folks do that, as much of a pain in the rear that is. But if they were, in your example, at $120 a month, and one of those REITs across town lowered it to $80 because they wanted to keep the folks that they have from moving and get a little bit more from folks that are coming from another facility, then it would be wise to be proactive and do the same to hold on to those and to be able to hold on to the facility before you get to a place where there's, we don't see a mass exodus in storage, but if there's enough folks that leave that you won't get back again. And if your rates are so high in the market that you're not competitive any longer, then you need to be the one that is proactive. Reduce rates to keep what you got, get a little more to weather that storm. And that storm could be just the winter, or that storm could be the recession in the form of a winter in the economy.
Right. I was actually listening to Tony Robbins the other day, and I heard him on 3 different interviews from 3 different podcasts. And he mentioned Ray Dalio's book, sort of the New World Order, or Surviving the New World Order. And one of the things that he said, and I think when you get to be of a Tony Robbins sort of stature, you have to pick your words sort of wisely. So I don't think this came up in conversation in a sort of a flippant way or without thought. And one of the things he said was, the pandemic was the winter, started our winter, and he felt like we were about halfway through that winter, with the war and recession sort of being the second half. And so I mean, let's just be honest. We're in a tough economic time. The country's facing some tough headwinds. And I don't think this, Scott, and I'd love to get your thoughts on this. I don't think that they're going to be able to let the air out of the balloon gently and slowly and sort of in that sort of transitory way that we've been told that this inflation will be. So I think that I think this is going to be a sort of a longer haul thing, a few years, like you said.
Mm-hmm. Well, and Craig, the reason why we're having this conversation is because, as you and I have discussed, this recession looks different. All recessions look different, and this one does look, you could say, dramatically different, or very similar to 2008. We had an abrupt end to the good times, the boom times in 2008 when Lehman Brothers fell. This time, as we entered that winter, it was when the whole country went into a lockdown. And now, pretty abrupt in terms of within 6 weeks, the interest rate hike, 1.5 interest rate hike has really brought a ceasing halt to the economy. Throw in a war on top of that, uncertainties in terms of food shortages, supply, labor shortage. there's a whole lot that has led to this place where all of a sudden, very quickly, we woke up and realized that, oh boy, things look dramatically different right now. So what does that mean? What does that look like going forward? I mean, I think it means that we need to look at, all facets of the economy right now to determine, exactly where do we go from here. And this winter, I believe, is going to last for a little while. And we need to, I don't believe that we need to sit back and wait it out. I think we, just like any good entrepreneur, any good poker player, any good competitor, tell me the rules of the game, so that I know what the rules of the game are. And if I'm clear as to what the rules of the game are, and I know what my resources are, and then I begin to look at opportunities within that framework, then it is still time to move forward and not to sit back and wait and look at things any differently. But we too are looking at and listening to the Ray Dalios of the world, the Tony Robbins of the world. There's a couple of other economists that follow self-storage very closely, the financial markets closely, and real estate closely. And there's about 4 to 5 folks that we follow very closely to keep an eye on where things are headed. And that, for us, is just to get a good handle on the rules. What does that look like going forward? And so, again, it depends. We don't know exactly what that's going to look like, but we feel pretty confident in looking at a project right now, whether it fits that criteria and where we feel that we're going to make going forward. And if not, if it's too risky and it doesn't tick all those boxes, then we pass. So does that answer your question?
Oh, absolutely. I think the winter is such a great metaphor for the sort of the seasons of life and the seasons of a country, the seasons of an economy. Winter always leads to what? Springtime. And so what do we do in the winter? Well, we take the nuts that we've gathered, we take the harvest that we've gathered and live off of that harvest. But one of the things that we do is we plan well for the spring that's coming, right? We don't just stop. We don't just go into our bunkers and pull the covers over our head, because we know that next season is soon approaching, right? And but I believe, as I know you do, Scott, in every season there's opportunity. There's opportunity to do some work, right? And right now, I just believe that the network that you have will be the single greatest asset that you have. If you can put together a solid network of folks who are smart, people who have been there before you, people who can hold you accountable and push you forward, folks who have more capital than you may have, that want to partner with you, other operators in the space. This is the network that will lead you into the next spring.
And you're seeing the activity level, Craig, which is where this is coming from. I mean, we're hiring and we're ramping up. And that is not only to be proactive, but also reactive. We've been out there doing this a long time.
Yeah.
We built a great reputation for ourselves, and that reputation is based upon the results that we get for our investors, and both active and passive, for the passive investors that come alongside of us and the active investors that we've taught to get into the business that have done extremely well with it. And so as we're heading into this cycle now, this season, this winter season, the requests, the emails, the contacts have been coming in to say, hey, I think I need a little help with this project. It's stalled, or
bet you're seeing a lot of that.
So we've got a robust pipeline of projects that we're looking at right now. And with the money coming out of Wall Street, these hedge funds and these funds that were created to invest in real estate are all now pointed towards self-storage. Because again, self-storage does so well during a recession, and they're looking for that yield and those returns. And so on the flip side of that, I'm very thankful that we have a robust pipeline of money that is looking to get placed into self-storage deals. And so, what we're doing right now is the same thing that we've always been doing, which is just doing it a little bit more now and more, a little more efficiently and quicker. And that is taking this conveyor belt of money that's coming into our organization by way of our private equity partners, and the conveyor belt of properties that is coming in, because we are the company that teaches people how to do this. We do lots of consulting and write lots of articles and speak on the stages, and so we have that exposure, and the deals are coming our way as well. So it's about your network. The brokers are one way of finding facilities and also sending out mailers and postcards, but until you create a large network of folks, then the deals will begin coming to you, and the same with the private equity. And that's what we teach, and that's what we continue to do each and every day. And that's why we built our mastermind as well, is to then put a group of A players in a room and that meets once a quarter, as well as our greater community that has access to even more private equity and the folks that they built up, and access to even more properties and projects that we can put together portfolios to invest in and invest with and put out there to the funds when they're looking to stroke a bigger check and not just a one-off deal. So the reason why we've been working so hard and just heads down, literally since 2008, but call it 2009 during that realization, is that we were preparing for this time. I said, I do not want to miss out on the opportunities that will exist the next time this happens, because we had to pass. We didn't have enough money. We didn't have enough equity. We didn't have enough equity partners to take on all the facilities we wanted, or the lending partners, or a team to be able to see all these through in terms of due diligence and the management side and everything else. And now, we have a team. We're 5 times the size that we used to be back then, and our Rolodex and our network has grown probably tenfold in the private equity side, and probably 4 to 5-fold on the acquisition and development side of the partners that we do joint ventures with. So now is the time. Don't think it's too late, and now you're missing the train for this recession. For the folks that are looking to get in, we have lots of opportunities. You want to come alongside of us, whether it be passively or actively, because this is what we do. We walk the talk. And we talk the talk as we're in this business day in and day out in the trenches. And so it is not too late to get involved in this industry, because right now, again, this is the time to get excited, not to be sitting on the sidelines.
It's really exceptional, Scott, what you've accomplished in just 14 years. And to some people, that may seem like a long time, but to you, I bet it feels like the blink of an eye in many ways. Mm-hmm. And I think you set out to, as you say, rule the world in terms of self-storage. And I think that's fantastic. For those people who have slightly smaller goals, slightly smaller dreams, they want a side hustle or some passive income in their retirement. I'd love for you to talk about what can be accomplished in 5 years in this business, in 2 years in this business, and in this type of market.
Well, it all starts, and this comes from a place of having an education company, and this is no self-promotion, but you got to get educated, especially now.
Yeah.
I mean, you need to understand the industry, not only just in terms, but underwriting. You got to know how to underwrite a self-storage facility to know what you're getting into. But even more so now than ever, you do need to have some folks to come alongside of you, and that's not just to have a good coach and a good mentor to make sure that you've dotted your I's and crossed your T's, but also the lenders now, if they're going to invest with someone, it's not going to be the first time you've invested in a self-storage facility. They're going to be looking to having, as part of your LLC, a partner, whether it be silent or active, that has experience. Because if you're just dipping your toe in the water and testing out during this most tumultuous of times, you're not going to get that loan. And the same with private equity. They're sitting on the sidelines, and unless you have a really compelling story to tell, meaning in a history of doing well during a recession, then it's going to be a little more difficult. So before you get discouraged, those of you that are looking to get involved, that just means you need to align yourself, and you need to plug into a network. You need to get mentors. You need to saddle up alongside of somebody in your community. If you belong to a real estate investment group or your local self-storage association, whatever that looks like, you're going to need to have partners and partner with them. And that means you're going to have to take kind of a back seat. It doesn't mean you can't go out and find the deals and find private equity and do all those pieces. But in order to get across the finish line, you're probably going to have somebody who brings some of that, but mostly experience to the table before
Absolutely.
You're able to get that done. And of course, our organization is, we're at the pinnacle of that. That's what we do. We teach people how to do it. People plug into our network to get access to deals, deal flow, and also to private equity and our Rolodex of lenders if it makes sense to do so. So again, no self-promotion. That's just the reality of it.
It's true.
It is the time to do so, but boy, oh boy, it's better to be a small fish in a big pond right now than to just be sitting on that sideline just waiting and being going in and out with the tide, waiting for something to happen.
When I used to speak in front of crowds, I would talk about my first several deals and how I was more than happy to give up 50% of the deal to the lender, right? My private lender was friends or family, and I would ask, what's better, to get 0% of something or 50% of a lot? Or I don't know if I even asked that question correctly, but you understand where I'm going with this.
100% of nothing is nothing if you don't move forward and partner with someone.
Exactly. And to get that experience just in the first few deals alone was invaluable. I had to pay anything for that. I'd have probably done it for 0% of the deal, just because the sort of springboard to all the rest was what was well worth those first few deals, right?
Well, and that's what I think there may be a lot of lone wolves out there, like I was in the beginning, who felt, I don't want partners. I've heard about partner nightmares, and I've just heard in general that you should never get into a partnership. And that was very, very nearsighted and short-sighted of my career in the beginning. It wasn't until I recognized that, well, first of all, I'm going to run out of cash, so I'm going to need to bring in some equity partners. And second of all, if I'm going to get into the development world, the lenders aren't going to take a chance on me if I haven't been into development. Even if I own existing facilities, the art and science behind development is completely different than buying an existing facility. And so I'm not going to be able to do that and be considered a player in the game unless I settle up along next to somebody else and get my first one under the belt. And so once you have that, whether you've invested passively like many of our investors, but they have equity in a deal, or whether they do a joint venture with us, you're correct. And I've seen it happen over and over again. Once they have one deal under their belt, whether they're in it or whether they've sold it, the next time they go in to do their own deal or another joint venture for that matter, they can hold their head up high and put their shoulders back and go into the lender when they ask, do you have experience in self-storage? Yes, I have. Yes, I do. Yes, I am in self-storage. And they can point directly to that. And that opens a conversation. It opens the doors. And that is the catapult, that is the springboard that allows investors to then move forward. And sometimes it takes, if you think it's just whatever, humbling yourself or feeling as if you're giving up or giving in, I think you quickly realize that maybe you don't know everything, and maybe that this person you partner with can teach you a few things, but more importantly, they're going to open a lot of doors just by being in a deal and working with somebody that's walked down that path before you.
Absolutely. Well, Scott, this has been a fascinating conversation, but I don't know if it's one that we can handle all in one episode. Obviously, we're facing a lot in terms of the economy. I'd love to talk more about it. You think we should do maybe a part 2, part 3 of this one, eh?
I think so, because there's a handful of questions that I think many of our students have and that you and I wanted to talk about that we didn't even touch on yet. And so, yes, during these times, I think it's best to do so. So let's head into part 2.
All right.
Hey gang, wait, 3 things before you leave. First, don't forget to subscribe to the Self Storage Podcast and turn on your notifications so you never miss another episode. And while you're there, please leave us a 5-star review if you like the show. Second, be sure to share your favorite episodes and more via Instagram, and don't forget to tag us. And lastly, head to the links in the show description and hit the follow and subscribe button on Twitter and Facebook to get a front row seat as we grow and scale our business and bring you along with us. Take care.